We're going to go ahead and get started. I'm going to hand things over to David. David, if you're ready, you want to go ahead and share your screen and unmute yourself.
Okay, can you hear me now?
I can.
Okay, great. Good afternoon, everybody. Let me get my screen shared here. Let's see. And then can you see the PowerPoint?
Yes, it's up.
Yes.
Okay, cool. All right. Well, yeah, again, good afternoon, everybody. Thanks for participating in this, and hopefully this will be informative. And there are several different, I've got about 10 slides in here, and we're going to go through several different topics. But at the end, we'll open it up for questions, and feel free to reference or have me bounce back to a different slide if you want me to, because we're going to go through quite a lot, and I want to make sure we have plenty of time to answer any questions if we need to dive deeper into any of the topics. So just really quick, getting started. Pinnacle Trust and Investment Services, we're a fiduciary asset management firm with Pinnacle Bank. We manage a lot of different types of clients' accounts. A fiduciary asset management means that clients are really giving us their money. We're determining the objective, and we're taking care of everything from there. We handle everything from the money side of things to their financial and estate planning, and then of course we have the bank side where we're able to service those needs as well. Little bit just about me. I've been doing this for about 13 years. Been in the trust world for a while as well, and really focused primarily on financial planning and risk management, and in those bank services. So first things first, investing basics. Really, you can go in a lot of different directions, but before you even think about going down the path of what should I invest in, first you got to make sure you have a really good picture of your financial household picture. So great place to start is one, and you should really reevaluate this every year, is you should write down a list of goals, those top 5, 10 things that you want to accomplish. Those goals can be big long-term goals where you want to, in 40 years you want to retire, or this is what you want to happen when you pass away. They can be things that you want to make sure to accomplish within the next 6 months or a year. They can be big, they can be small. You should just write everything down that's a goal from a financial standpoint, and make sure to put a date on there where you say, within the next 5 years, I'm going to do X, or I want to do, to go on that big European vacation when we're able to travel again, or whatever it is. It can be big stuff, little stuff. I always encourage people to really think about it, to talk to their partners, to talk to their family about it, to really give it a lot of thought. Once you've done that, you've got to go in and get a good understanding of where you are, where your household is financially. And the two things that you've got to do are create a net worth statement. So this is making a list of those assets. So bank accounts, retirement accounts, homes, any property, any investments, any cars, property, just everything that you have, assigning a value to all of that, and then also your debts. So your mortgage, your credit cards, any bank loans, car loans, student loans, listing all of that out, being honest about it, so that you can see where you are today. And then also, where is money going in? How is money coming into the household, and where is it going? It's always it's for everybody, even for people who do this for a living for other people like we do. It's always very telling to go in and just look at your bank statement, your checking account statements, and seeing where money's actually going, and how much you're spending on certain things every month or every year. It's really important to see that, so that you can take that information, take your net worth statement, and apply it to those goals and those things that you're trying to accomplish. So once you've done that, you've got that good understanding of where you are, where you want to go to. You want to make sure first, before you invest in anything, you've got to have a good emergency fund built up. An emergency fund is cash that you can get to right now. Typically, you'll hear people say 3 to 6 months worth of living expenses, kind of depending on your household and depending on how income works in your household. What's appropriate for you, might be a little more than that, a little less than that. It just depends. But you've got to have that emergency fund built up, and an emergency fund is, again, cash that you could go and get to right now. If that water heater goes out, and you've got to buy a new one. You want to be able to get that money from cash rather than having to put it on something like a credit card that's going to be high interest. So start there, build that emergency fund up, look at your debts. If you have any debt that's high interest, so you see that with credit cards or just any high interest loans, build that plan to pay those things down to zero. It's very, very, can be daunting to look at that, but if you build a plan and you stick to it, you stick to how much you're going to put to that goal every single month. Once you get that thing paid off, whatever it is, the credit card, the loan, whatever it is, you've already built in a habit of paying that money. So if it's $100 a month more than what you're paying now, and you get that thing paid off in a couple of years, you can then take that extra money that you're already used to sending somewhere else and put it toward your savings and your investing goals. But before you really jump into investing in something, do look at what that debt picture looks like in your household and build a plan to pay it off. And again, what are savings? Savings are going to be, checking account, savings account, maybe a short-term CD. Pros, they're liquid, they're safe. It's FDIC insured, it's at a bank, it's fine. The cons are zero or really low return, and that likely is not going to keep up with inflation. Really quick, going through this before we jump into what types of investments are out there. Too often people don't take into account the impact of inflation. So if you look at the graph on the left, $10,000 in 1980, almost 30 years later in 2019 would have the buying power of only $2,800. What that means is, so inflation is saying, how much will my money today buy me in X number of years? So that $10,000 in 1980, if it just sat in cash in a bank account for 30 years and 29 years, it would only have the buying power of $2,800. Look at the graph on the right, it's an opposite story. If that money was invested, average return of 6%, which is a pretty conservative rate of return for certain equity investments, that $10,000 over the same period of time would grow to $54,000. So think about that when you think about where you're going to put, where you should put money. Too often we see people that have too much cash and they're not taking into account the fact that that cash is not going to, that every single year that money sits in cash, it's losing an average inflation rate of 2% because it's not working for you. So how do you get your money working for you? There's a lot of different types of investments. I picked out these three because they're the most common. There are other types of investments out there, like real estate, commodities. There's people that invest in art. There's people that invest in collectibles. But these are the most common and most readily available, and what you hear the most about. The first one is a bond. What a bond is you're basically loaning money to a company. So say General Electric issues a bond, and they're saying, if you give us X number of dollars, you give us $10,000, we're going to pay you normally it's a fixed interest rate over a certain period of time. So in this example, GE said, we're going to issue a 10-year bond, and it's going to pay 5%. If you purchase that bond, you would give them $10,000, and they would pay you. They're promising to pay you 5% each year for 10 years. At the end of that 10 years, you get your last interest payment and your initial investment back. Of course, there's always a risk to that. If the company you're buying the bond from is not a healthy company, or something happens to it in the future, they could either stop paying the interest, or if they go bankrupt, you could actually end up losing your investment. But generally speaking, bonds are considered, whether they're issued from a corporation or issued by the federal government, which the federal government issues bonds as well, considered safe investments as long as they're from quality institutions. The pros of a bond is, if you're looking for income, so if you need to generate income off of the money that you've saved, a bond could be a good place to do that, because you're getting a steady stream of income from it every single year. Cons are likely that bond is not going to mature in value. So when you're looking to grow your money, you're not looking to take income from the money, but you're looking for that income, or you're looking for your money to grow. Oftentimes you look to stocks. So a common stock is issued by a publicly traded company. So just like, again, using General Electric, they have common stock. Common stockholders are owners of the company. They could receive dividends, which a dividend is really a return of profits from that the company sends out and pays to the stockholders. Pros is that as long as it's a good company, that stock is going to actually grow. So your $10,000 investment will go up, but it's also more volatile. It could also go down. A bond can go up and down in price, but it's not going to be as volatile as stocks. So again, if you think back to what we were talking about in something like an emergency fund, you wouldn't want your emergency fund to be in an investment like stocks, because if you needed that money and we were in, say, the situation that we were in March, where stocks went way down, and you had $10,000 saved, and all of a sudden your $10,000 was only worth $8,000, that's not really appropriate for something like an emergency fund, because you need to be able to get to it really quick. Mutual funds and ETFs, what they are is they're actually a pool of money. So everyone that invests in a particular mutual fund or ETF is pooling all their money together, and there's a professional money manager who's actually taking all that money and investing it based on whatever the objectives are of that mutual fund. It's a great way to get your money diversified, because you're pooling all of the investors' money together. You can create more diversification, so you're able to invest in different sectors and different types of investments, where you as an individual, or me as an individual, maybe wouldn't be able to get that broad of a diversification because we don't have enough. So it's a great tool. It offers, again, diversification and professional management, so you're not having to go and pick the investments. You've got somebody in there picking the investments for you. Cons are some of them can be really expensive, and also that you just don't control the investments that are inside those mutual funds and ETFs. But again, when you're getting started, and especially before you really get to a certain dollar amount, mutual funds and ETFs can be a great solution to provide that diversification, provide that professional management. What you get with diversification as well is stability. So if you are diversified, and say one or two of those stocks inside of the mutual fund go down, it doesn't hurt you as bad, because you have all these other investments in different types of investments. Whereas if you just had one or two stocks, well, if one of those stocks goes down, then half of your portfolio is going to go down. So it's a great way to get that diversification. It can provide some stability, and again, picking the right one. There's thousands of them out there. There's good ones and there's bad ones. Picking the right one is really your most important part. And so that's where you get to, how do I know what to invest in? So everyone's at different stages of their life. Everyone has different family circumstances. The first thing to do is think about what you need. What do you need this money to do? Are you saving it for retirement, so you're not going to touch it for a long time? Are you saving it for something that you need in a short period of time? Do you need the money to grow, or do you need to take income off of the money? Those are your three objectives. Do you need to grow? Do you need income? Do you just need to preserve it? Or do you need some combination of those three? And then you get into risk tolerance. So this says, how comfortable are you with opening up your statement and your balance being down? You know, if you're comfortable to take on more risk, then you can potentially have a higher return. But you never want to invest in something without understanding that if it's an investment that can go up and down, you know, that you might lose money for a period of time. And having those conversations and understanding that whether you're doing your investments yourself or you're working with someone who does that, like we do for people, making sure that you understand the potential ups and downs and pros and cons of each investment is really important. Diversification, again, it can reduce volatility and provide more stability of earnings. And then, do you want to do it yourself, or do you want to hire someone? You know, if you can go online right now to Schwab or Ameritrade and open up an account and start investing today, but you're doing that by yourself and you're making the decisions by yourself. Some people do that and they like doing that. Others, look to somebody to provide that advice so that you're not having to pick those investments every single day. You have someone who learns about you, learns about your financial picture, learns what you're trying to accomplish, and says, okay, here's our recommendation, and getting your go ahead. I went through that all pretty quick, and I want to go to this is kind of our last slide in thinking about where to put your money. So we talked about that emergency fund. Think about the different accounts that you have or that you could have as kind of buckets of money. So that short-term bucket, again, cash, you can get to it immediately. Again, your stove goes out. You need to be able to go buy a new stove with cash instead of having to put it on a credit card. That's your first bucket. You kind of have a midterm bucket that's there for those shorter time frame goals, 1 to 5 years. In that type of bucket, you could have a combination of cash and some investments. You again want to make sure that you understand the time horizon. So if you're looking at that 3, 4, 5 year period, maybe you can take on a little bit of risk to try to get a little bit of earnings. And once you get closer to that point where you're going to need to use the money, you need to de-risk, get that money into something like bonds or cash, so that again, if the stock market goes down, your goal is going to be intact still. And then you have those long-term buckets, and those are usually things like retirement accounts. You have 401ks, IRAs, Roth IRAs. There's a bunch of different types of retirement accounts, but those long-term buckets are where you can really do a lot of saving, but you can also have potentially take on a little bit more risk, because if your time horizon is 10, 15, 20 years before you're going to retire, you're able to take on a little bit more risk and weather those bumps in the markets, because you're not going to be using that money for a long time. So with all of that, does anyone have any questions? And if you want me to jump back to a different slide, just let me know.
And folks, you can unmute yourself to ask questions or drop them in the chat, and I'll let David know.
Okay, David,
Yes.
what do you think of like once a person gets to a certain age, the risk factors that you should take and you should not take?
Yeah. So there's several schools of thought on that, but the general main thing to think about is the closer you get to retirement, the less risky your investments should be. So if you're 20, 30 years away from retirement, then you should be taking on a lot more risk than someone who's 4 and 5 years away from retirement. So what that means is those two portfolios, the person who's 20 or 30 years away from retirement should have a very stock heavy portfolio. They should be whether it's utilizing mutual funds or just individual stocks, they should be invested heavily in equities, because those will, in equities or stocks, so those stocks will have a greater potential of appreciating than something safe like bonds. As you get closer to retirement, though, that mix should become more and more bonds the closer you get to retirement. Sometimes you see these, if you have a 401k, most 401k plans have what are called target date funds. So it says if you pick what date or what year you're planning to retire, and what that target date fund does is every year that you get closer to retirement, it's changing that mix of your portfolio to making it less and less aggressive and more stable. They work great for.
What are your thoughts like the investments apps like Acorn or Stash? Would you suggest those, or is there something additional to know about that?
And so I didn't catch what's the investment that you're talking about?
Apps like Acorn or Stash.
The ones that round up your transactions and put money, the systematic savings apps.
Yes, sir. And then they do invest a portion of that.
Yeah, I think that, I'm not familiar with those exactly. I'm just familiar with the concept of how some of these work, where they're either rounding up your transactions. So if you buy something and it's $1.50, they're going to put 50 cents into an account for you. I would just say, just be aware of what they're investing in, and also be aware of what's the purpose of that saving. So if you are utilizing something like that, is it to build up that emergency fund? And if so, they shouldn't be investing in anything. It should just be going in cash. If it's so that you can, you've got your emergency fund built up, so you're willing to take on some risk, just know what they're investing in. I do think, and I have had clients who use, and it's not those two, it's another one, but they do use and swear by those systematic savings apps that, it's kind of out of sight, out of mind, and they just have a certain either dollar amount every week or per transaction go into an account, and they use that for vacations, or they use that for Christmas or something like that. So I think the most important thing is knowing what the investments are and being comfortable with them, if there are investments involved, and also what's the purpose of that money are the two big keys.
Okay, David, I also have another.
Go ahead.
Okay, this is about once a person turns 70 and a half, and you get that required minimum distribution, what do you suggest that a person does with that?
Yeah, sometimes, so it depends. If you don't need the money, and so what she's asking about is, if you have money in a retirement account, when you turn 70 and a half, the government makes you take a distribution from that retirement account. retirement accounts that are like IRAs, 401ks that you've never paid taxes on. So the government wants their money, and they want you to have to pay taxes on it. So they force you to take the money out. Now, what to do with that? The best thing to do first, if you don't need the income, planning for that beforehand, before you're forced to take it out, is really the best thing to do. So when you're 60 years old, really, if you are over 59 and able to take money out of that retirement account, going ahead and building a plan and having a purpose to go ahead and take money out and get the taxes out of the way before you're 70 and a half and you're forced to do it, that's really the best thing to do. Again, it'll depend on each individual tax scenario, but if you can get that money out of that taxable account where you have full control over it, that's really the key. If you're not at a place, or if you don't do that and you're 70 and a half and you have to take that required distribution, it's going to depend. If you don't need the money, then put it over into an investment. Some people, there are tax ways that you can use that for tithing. You can give it to a charity, and it could be a potential tax benefit to you to do that. It's going to depend on your circumstance, but again, if you don't need it for income, don't take it out of that account and just shove it into a savings account. Do something purposeful with it. If nothing else, get it invested again, if you can. But do know that there are some tax strategies you can utilize again before you're 70 and a half. Building that plan to actually get the money out of that taxable account and getting it into an account that you have full control over, or when you are 70 and a half, there are some ways that you can minimize that tax burden.
Thank you.
There's a couple of questions in the chat. I'll just start reading them. The first one is, I was recently referred to use SoFi by a friend. What do you think of automated investing opportunities?
Yeah, I think the key there is knowing what you're investing in. There's nothing wrong. Those are great strategies to set up. Again, it's kind of an out of sight, out of mind thing. You just got to know what the investment is. You can do that yourself with individual companies, or again, you can use these services. Just know what the investments are. But generally, yeah, it's a great idea. It's like participating in your company's 401k. You never see the money; it goes straight into your 401k. If your company matches, you're getting that additional contribution. But if it's not something that you're having to write a check for or make the transfer for, and you can get something like that set up and then just don't think about it and just let it build, that's great. But just make sure you're comfortable with what you're investing in.
Okay.
I think
I was just going to keep reading questions from the chat.
Okay.
The next question is, what sites or blogs or magazines do you recommend for people wanting to get into stock investments?
You should read the Wall Street Journal every day, just in general. Recommending like specific sites. Well, start with Wall Street Journal, CNBC, and Bloomberg. They're going to give you just kind of the most broad, general. Here's what's going on in the markets information, and then that's going to take you potentially to some more specific sites, maybe if you're really interested in tech or you're really interested in manufacturing. But I would just start there and start with those, start with those basics to get an understanding of what's happening in the world and understanding what's happening in all these different sectors and all these different markets. It'll help you. It'll help to give you a better idea of when you are looking at some different stocks or mutual funds, what's happening in that industry or what's happening in in that type of investment. So I'd start there. I also just myself will go to, and this is a subscription site, but it's wealthmanagement.com is really good. It's more detailed. It's more specific, but it is if you're in for a good long reads, it's very informative as well. Wealthmanagement.com. This is another one that I read.
Okay, I'm going to combine some of the next couple of questions. So the question is, before I can afford an investment manager, how do I know what to invest in? And I'll tack on, there's a couple more that want to know, who can you use to buy your own stock? How do you buy your own stock? And are there any websites that you recommend?
So you can go to charlesschwab.com, Ameritrade.com, and open up an account where you invest. You're doing that all by yourself. You open the account up, you type in Apple, and you can buy Apple stock. I would stick with the big names, the old stable names like Schwab and Ameritrade. There are other companies out there. You have probably heard of Robinhood. Robinhood is very, very popular these days. It's an app. It's really easy. Again, you're doing it yourself. You're buying and selling stocks yourself, but it's very easy. You can set up systematic savings plans through them as well. So any of those options are going to be okay. Just know that you're making those decisions yourself. I wouldn't worry about the question of before I can afford a money manager. There are different types of managers out there. So someone that works at an advisor at Raymond James or Edward Jones or even at a bank, they're going to have options for every level of investor. They're going to have an option for the person just getting started, and they're going to have an option for somebody who's been investing for 40 years. And cost-wise, I wouldn't worry about that. You just need to go out and actually talk to some of those people. You could start even at your bank. Depending on your bank, if most of them have people who do investing for people. So you could start there. You could just again find a Raymond James or an Edward Jones advisor, and some of them will only work with people who have a certain dollar amount. But there are plenty of advisors out there who work with people from scratch, from the very beginning. You have to be really, really careful, like using like Robinhood or investing in stocks, investing in anything yourself. You have to be really careful understanding what the risks are in that investment. And that's where, again, what's the purpose of the money should be the first thing. Why am I putting money into this account, and why am I buying that investment? What's the ultimate goal? When am I going to ultimately be using that? What am I going to be using it for? It's something that you need that $1,000 that you've saved up, or you might need it because you have to buy a new water heater. Then you shouldn't be investing it in anything risky. you need to be building a more risky bucket somewhere else.
Okay, we have a question from Lindsay. She wants to know, when do you know to pull out of an investment?
Well, I think if anyone can answer that accurately, then they'd be the richest person in the entire world. That's where diversification and then understanding the purpose of the money are so huge. There is no answer to that. Anyone that tries to answer that, you should run from them. If you're invested in anything other than cash, there is going to be a risk to that investment, and it just depends on how risky it is. So the key is having the right mix of investments where when things do get bad, when we do like March or we have a 2009, we go into a recession, when those things happen, you need to understand that you're okay because you have money, again, in these different buckets that can weather through that storm, and you're also diversified in a way that you're not being as impacted as that somebody who's in pure stocks. So I think that another way to answer that question is work with a professional to make sure that your investments are diversified the right way.
Okay, we have questions from Ethan. He wants to know, are there any specific sections of the Wall Street Journal that one should focus on? And are there strategies for understanding how to read the information?
Strategies on how to read the information. There's a really good, I think it's through Forbes, there's a really good site called Investopedia.com, which, if you're reading something like the Wall Street Journal and it says, it uses a term and you're like, what is that? Investopedia.com probably has a really good answer for it. I would keep that in your back pocket all the time. So when you're reading through the Wall Street Journal, or you're on CNBC.com or Bloomberg.com, and you're like, what is this? What are they talking about? I bet if you typed it into Investopedia.com, they've got a really good answer and a really good article about understanding what they're talking about.
Okay, he also wants to know what your thoughts around transferring funds from a CD or mutual fund over into an IRA or IRA Roth account are.
That is going to depend on your overall financial picture. As long as you don't need the money until you retire, absolutely. I mean, that's going to be, again, you've got to fully understand your financial picture first, and not knowing, I don't want to tell you specifically, yes, go do that. But if you don't need the money until retirement, then generally, yes, that's a great thing, because the money is going to grow tax deferred. If you're putting it into an IRA, if you're able to utilize a Roth, and if it's money that's in a CD already, you've already paid taxes on it, so you really should put it into a Roth, because that money, you won't be taxed on the earnings when you pull it out, rather than an IRA. If it's money that you haven't paid taxes on yet, then you should utilize both, either a Roth or an IRA. But generally, yes, both of those types of accounts, if you aren't going to need the money until retirement, the tax benefits of both are great. Your money will grow without having to either, whether it's a Roth or an IRA, by providing those tax benefits.
Okay. Continuing kind of down on the path of CDs, he wants to know, would it be better to go with a 6-month, 12-month, 18-month, or 24-month CD? What's the difference for the pros and cons related to each for someone just starting out?
Right now, CD rates are awful. So just know that, it might be the only place, and it is for some people, but you really should shop around with CDs right now because the rates are really bad. The difference is the pros and cons are purely the duration. If you're buying a 2-year CD, then you're not touching that money for 2 years. I would not do that right now in this rate environment, unless it's, again, if it's money you do not need for those 2 years, maybe, but the difference and you've got to just look at what the rates are, what you're going to get paid, what the interest rate is on that 2-year CD. What's the difference in that rate and the 1-year rate? And I haven't looked at them in the last couple of days, but I mean, the difference in what they're paying is not that much. You're having to tie your money up for longer. So just look at the pros and cons when you're looking at them. Just look at how much are they going to pay me and how long do I have to tie my money up, and make that decision from there. But CDs are right now, no CD that I'm aware of is even keeping up with inflation. So keep that in mind too. But do shop around. There's a lot of, some banks, depending on, some banks will need to, when they're trying to raise money, sometimes they'll offer some pretty good rates. And there's also things called brokered CDs, that you could go to your bank and talk to one of the investment people there, that they might be able to. And a brokered CD typically offers a little bit better rate than what the actual banks are offering.
What do you think?
Okay.
Banks versus credit unions.
Credit unions are great. Banks are great. They really serve two different purposes. Credit unions are they're extremely valuable to the community. They do a great job with personal banking. They will typically do like smaller loans than what other banks will do, which again is needed for the community. Credit unions should be your kind of go-to place if you're looking for that, a loan that's under $5,000 or $10,000. You should always go to a credit union. They usually do a great job with car loans as well. And again, they're great with that, that personal banking. They're great. When you get into actual banks, and then community banks, regional banks, and then large national banks, they all kind of have a different purpose. A community bank will usually do some more riskier local lending, which is good for that small business owner who's just getting started, or they might just have an appetite that the bigger banks aren't willing to take on. So again, they're great for the community. They're great for small businesses. A bank like ours it kind of fits in that mold too, but we're also big enough to do some of the bigger lending and provide kind of just more services to people. And so we fit that need. And then those big national banks, Citi, Wells Fargo, they're all just kind of offering, cookie cutter products out there that, again, are needed. Everyone needs a checking account. Everyone needs a savings account. They have, typically will have a lot of resources and technology that the local banks won't have. So it kind of depends on your purpose, on what you're trying to do, but just specific to banks versus credit unions, they both serve a really important role. Credit unions especially serve a really, really important role. Usually, again, with that personal banking, and then those like smaller loans, car loans, and smaller. They usually do a better job than the banks do on those, and they're just good for the community. So.
We have another question from the chat. It's related to paying off debt. It says, for example, if you have $10K in debt, should you pay that off before making any investments?
I think that depends on the rate. What kind of debt is it? You know, you've probably heard that someone say, like, is it good debt or bad debt? Good debt's going to be debt that the interest rate on it is lower than the rate of return you can get on an investment. So if you have a 1.9% car loan, you should probably, that's not bad. That's not necessarily bad debt. It can be bad debt if it hurts your household cash flow to make that payment, or it's inhibiting you from saving enough for retirement because you have that car loan. But the loan itself is not bad. Now, if you have $10,000 and it's all on a 15% credit card, then yeah, that's where you need to build that plan, that monthly strategy of, all right, I'm going to pay this. I'm going to pay this off. By adding X number of dollars more to my payments every month to get that paid off before you jump into investing. You need to do that because you're not going to be able to keep up. Your investments are not going to be able to keep up with the interest rate that you're paying on that debt. Now, you can do both at the same time. Again, it's going to depend on your household cash flow. You shouldn't hurt your retirement savings plans. Don't focus on debt reduction to the detriment of savings, but do prioritize. If you need to put more money toward paying off that $10,000 now to get it paid down faster, so that you can then shift that same dollar amount into what you're doing, from a savings standpoint, then that's usually the right thing to do. If you have a company that offers a 401k and they're going to match it, you should always do that. At least do up to the match. And then outside of savings, you just got to have that balance of debt reduction and savings. And once you've built the emergency fund up and paid off the high interest debt, again, then you can shovel all that money that you were putting into those two places into other investments.
Okay, there's a question from the chat along the lines of what you're talking about. She wants to know if it's better to make an extra payment toward paying off your mortgage or using that money to put into retirement/investing.
Yeah, how long are you going to live in the house? That's always to answer that question. It always depends on how long you're going to live there. Most people do not live in the house that they're in for 30 years. If you just bought the house and you have a 30-year mortgage, but most mortgages are paid off, I think, in 7 years. Meaning you sell the house and you move somewhere else. So if you're not going to live there, if you're going to move in 2 or 3 years, then there's no reason to make that additional payment. If you're going to live there for a long time, then it could make sense. It could make sense to making an additional payment, but that's only if you're on track with your retirement plan savings. So it just depends. If you're behind on retirement savings, you need to put it in retirement. If you're on track, and you're going to live in that house for a long time, it probably would make sense to try to pay your house off faster.
Okay. Another question from the chat. What are your thoughts around hedge fund charges, and how does that come into play within the role of work performed by your company?
Hedge fund charges?
That's what it says.
Okay. If you mean if you're talking about the fees that hedge funds charge, normally they're right. They're kind of right in the where they should be. It's usually a fee based on how much you have invested with them. So if you have $1 million with them, you're going to pay, 1% or 1.5% of that $1 million to them as a fee. We don't utilize hedge fund strategies here. We do plain vanilla, safe, good investing. So we're never going to, we're going to always beat the markets, but we're never going to, have an account that has a 120% return. We're the steady as she goes investing, fiduciary investing, traditional investments that you can understand. We don't utilize things like hedge funds, and I'm not saying this in a bad way, but we don't use anything like that are illiquid and just difficult, complex strategies for our clients to understand. It doesn't really fit most people's. It doesn't fit most people's overall portfolio or objective. There are ways to get that same type of exposure without having to utilize a hedge fund.
All right, folks, I think we have time for about one more question, and then we are going to have to wrap things up. So does anyone else have a question for David? The only thing popping up in the chat are a bunch of thank yous.
Oh, well, thank y'all. And y'all, awesome questions. If you have any others, I mean, I'm happy to stay. And actually, I meant to leave. I'm sorry. I meant to leave up this last slide that has my contact information. If you ever just have a question or anything, just feel free to reach out to me. That's my office number and that's my email. Happy to help or answer any questions anytime in the future.
Okay. I'm gonna wait just a minute or so before I launch the poll so that you can all see his contact information and jot it down if you need it. In the meantime, before I launch the poll, there are a couple of you on the phone that I need to get your full name and some contact information because you don't show up, you show up as something else. So just going through real quick, there is a Crystal on the call. If you could let me know what your last name is. So I can see if you're on my registration list. Hello, Crystal, can you hear me?
Oh, can you hear me? Can you hear me now?
Yes. Yes.
Okay, good. Sorry. Yes, it's Crystal Brown. I'm sorry.
Crystal Brown. Okay. I thought that was probably your last name since I saw there was a Crystal on my list, but I wanted to make sure. Thank you, Crystal.
Thank you.
There is another person that is showing up as hello. I don't know if you want to share if you would like to share your information, please do so.
Shanita Bryant.
Okay. I see you on my list. I have your contact information. Thank you. Let's see, there's someone showing up as iPhone.
Tawana Duckett, maybe.
Okay. You're registered as well. And there is a Lisa on the line. Just want to check the last name. Is it Lisa Flores, maybe? Okay. I don't, she's not answering. Okay. And then there's a Mindy on the line. And I'm going to guess that that might be Mindy Ruffalo. Oh, she just dropped off. Okay. All right. So I'm going to launch the poll. If you'll should take just a quick minute to answer the questions. And like I said at the beginning, for the folks that stayed on the line today, you'll be entered for a chance to win a Nintendo Switch. And for the folks that complete this poll, you'll be entered for a chance to win some Apple AirPods. We'll be announcing those giveaway winners next week. We do have 3 more virtual money school classes remaining on our schedule, 2 of them this afternoon and 1 of them tomorrow morning. The topics covered are Go Green, Save Green with EPB, and there is a Section 8 voucher to homeownership class tonight, and then tomorrow morning State Farm will be presenting on insurance. So if you guys have the chance to attend those, please do. And to David, I'll go ahead and say thank you again. If you can stop sharing your screen if you wish.
Okay.
We really appreciate your participation in today's presentation.
Well, great. Yeah. Thank y'all, and have a good rest of the afternoon.
Thank you.
Lindsay, I see your questions in the chat related to registration. You no longer have to register for those classes. The Zoom links are available if you go to the Money School website, which is www.moneyschoolcha.org.
Thank you.
No problem. I hope you can make it. All right, it looks like everybody's completed the poll. I appreciate it. It's Friday. Yay. I hope you all have a great rest of your day and you enjoy your weekend, and thanks for attending today.